Hello, everyone. Welcome to this episode of Coffee with Carl. I'm your host, Carl Zellner, one of the attorneys with Anderson Business Advisors. Thank you for joining me for another episode. As always, please remember to like, subscribe, and share with a friend so we can continue making this free content for you. What I'd like to talk about a little bit today is some different things in regards to the California Franchise Board that get sort of not talked about or glossed over, or also sort of pick and choose what everybody's talking about. One piece I want to start with here is the LLC fee. You can see the screen pulled up next to me or in the same screen with me here. The LLC fee in California is no joke either. We usually just talk about the California Franchise Board, our franchise tax being $800. To be fair, that's where it starts and then it goes up. So you can see the next level up isn't that big of a level up, I guess, if you're talking about running an active business. So you're talking between over 250,000 up to $499,999 is going to be an additional $900. So now you're talking about a $1,700 effective, basically franchise fee there. Then you look at over $500,000 goes to $2,500, over $1 million is $6,000, and over $5 million is almost $12,000. So something just to keep in mind there too, because that's one of those things that sort of gets left out of the equation, especially when you're being selective about your equations. So that being said, let's take a look at an article that is very selective about its equations. I've had several clients call in and be concerned about this, so I also wanted to take the chance to be able to address this as well. There is an article out there that is basically claiming to compare an LLC versus a statutory trust in California. Anderson Advisors and myself suggest statutory trust for our clients in California who are intent on avoiding the franchise tax and franchise fee. What I would look at here is ultimately this scenario, and those of you who are familiar with the article have read it. Those of you who are going to look for it after you see this video, that's fine too. Just be aware it is, I would say, hogwash, I think is the kindest way to put it, because ultimately they never address how that statutory trust is taxed. And you can tax a statutory trust basically however you'd like, almost like an LLC. So, or basically the same as an LLC. So let's actually do the side-by-side comparison that they were trying to do here. However, in this scenario, if it was actually an apples-to-apples comparison, it would be Sean has an LLC in California that's also taxed as a corporation. Scott has a statutory trust that's taxed like a corporation. So what would that mean, though, for the equation? It would mean the equation is completely wrong in the Sean version of the equation, because you'd have to actually add that $88,400 for the corporate tax in California as well, if Sean's LLC was taxed as a corporation. So next piece here is also that if it was, then you have to go back and add the $11,790 as well, because ultimately it says in the bottom part of the equation or scenario that is now worth $6 million. So it's now worth $6 million, so it now has to pay that franchise fee of almost $12,000 as well. So I say that to say this is ultimately there's always going to be articles and things like that out there to scare us, especially if you live in California. Work with somebody who knows what they're doing, and you shouldn't have a huge concern there. However, California is tax hungry and will continue to have their hand out. There is no signs of that stopping. But like I said, if you're going to work with people who actually know what they're doing, deal with California clients, and have a long history of working well with the California clients and helping people as far as you can push the envelope, avoid unfair taxes in California, then so be it. I would say that to say this is that Anderson Advisors is that company that can help California clients find the most tax efficient way to live in California and invest in California, if that's what California folks are intent to do. So please, as usual, keep taking advantage of all of our free content that's out there. Just as a reminder, if you got a buddy or somebody who submits you this article and says, look, You don't want to be setting up statutory trusts. Look how much you'll be paying. Just remember the two pieces of the puzzle on this one is, number one, this is not the apples to apples comparison it purports to be. And number two is that ultimately, if it was, you would see that the LLC would be taxed as a C corporation and actually be getting way more hammered than the statutory trust. So in this scenario, like I said, the statutory trust is most likely taxed as a corporation, but that fact is conspicuously left out of the article. And then ultimately, if you come around to it, there's no point to be made logically, right? I mean, they're doing business. The scenario even sounds like they're running an active business. And if they're running an active business, so there should be in a corporation anyways. So they should be paying the corporate tax when they're making it. So ultimately, statutory trust is good for a lot of things, especially for real estate investors who are looking to shelter some of that passive income you get from rental properties. For active businesses, it is not a great fit in California for this reason, is ultimately, I feel like if you got sold a bill of goods, that by setting up a corporation, you can, through a statutory trust, you get to avoid the corporate tax, then I think you're left wanting. But like I said, from our perspective or from my perspective, and I work at Anderson, that's not how we would set it up. We would set it up as a disregarded statutory trust, so you wouldn't have to deal with the corporate tax. So, like I said, it's pretty straightforward once you delve into it a little bit. Most people don't have the time to delve into it, which I would say this article writer, the article came out at the end of 2023, probably didn't spend. They spent time on it, obviously, because there was an aim for it. I think they missed the mark, is I guess my overall opinion. I mean, good on them for trying to create some conversation around it and trying to freak people out to a certain level. Like I said, I have had clients bring it up, but once we go through it, most people feel much better about it. So that's why I'm making a video so it can be shared with people as well, especially if it's your friends at the local RIA who are trying to freak you out or freak other people out. You can share the video and we can go through it together. And if there's additional questions, you're more than welcome to reach out. Anderson Advisor does provide consultations for clients as well, and non-clients or to-be clients. So please reach out if you're looking for a consultation. Happy to spend some time and chat with you. Like I said, sort of overall summary, statutory trusts are good for California investments for passive income producing activities. So non-active businesses. So not like if I had a law practice in California, I wouldn't set it up as a statutory trust taxed like a corporation, or I would at least run the numbers to see if it's right. But I think this sort of overall scenario here is a little bit missing the mark, because I think it's a little bit framed in a way that confuses people. So till next time, thank you for joining me for Coffee with Carl, and we'll catch you all in the next episode. Thank you.